When investors talk about beating the market, they usually mean picking stocks. That's one way to do it, but an arguably safer, more consistent way is to use historic market trends to weight your portfolio towards the asset classes currently in the dips of their long-term value cycles.
All asset types move in cycles relative to each other on a grand historic scale. Gold, for example, will spend decades valued highly relative to stocks, only for the pendulum to swing back the other way and become comparatively cheap.
By analysing how asset values have moved against each other over decades, we can see patterns that repeat themselves and choose to allocate our portfolios more towards assets that are currently cheap. This is about stacking the deck in your favour. It's the long-term approach to beating the market. But which assets should you allocate more towards? Let's check it out.
Welcome to Unshackled.com, the investing and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Check out Unshackled.com, linked below, to scoop up free stocks, cash and other discounts when you open an investing account through any one of our many partners. These include Free Trade and Stake, who are giving away free stocks. Go check them out.
Relative asset values. Working out if it's a good time to buy into a type of asset is possible by comparing two assets directly against each other. It's no good looking at their cash values, as almost every asset type has gone up massively in cash terms over history. So not very helpful for analysis. That's because cash is constantly losing value to inflation, exaggerated by government money printing programs.
But between the other asset classes, the differences in their values change slowly over time as they fall in and out of fashion and as a result of a gradually changing world. 120 ounces of gold will buy you an average UK house in 2020, but in 2004 you'd need 350 ounces of gold.
There'll be times when a house could be sold to buy 2,000 shares of X company, and another time that this same property could be traded in for 3,000 shares of the same company. Cash values don't come into it at all. In this video, we'll be comparing assets directly against each other to work out which are best placed to outperform over the next couple of decades, starting with
gold versus stocks. The story of gold is fascinating. Going back 70 years, we see reasonably smooth cyclical trends going up and down. The graph is showing a trend line for the value of gold divided by the value of stocks, for which we have used the S&P 500 as a proxy for all stock markets.
In 1950, 1 troy ounce of gold was worth 2 times the S&P 500. In 1982, 1 ounce of gold was worth 3 times the S&P 500. In 2011, 1.5 times, and so on. A reasonable man or woman in the street may have assumed that the relationship between stocks and gold would either be a flat line or a random zigzag over time. But what we actually see is a cyclical trend, the ratio moving in decades-long curves.
Gold is currently at a low valuation relative to stocks, but it's important to understand the context of what was happening in the world at the time during each dip and spike before we pile our money into gold.
The 50s and 60s saw a recovery after the Second World War, with stocks outperforming safe haven assets like gold as economies picked themselves up again. Then in 1971, President Nixon took the dollar off the gold standard, which had previously fixed the price of gold at $35 an ounce, which explains this sharp spike as gold was let loose to find its own value.
The trend continued upwards during the early 80s, leaving this chart entirely and hitting brief highs of 6.4 times in 1980 when high oil prices, another asset class, caused high inflation across the world.
Then stocks took over again. The period from the 80s to the millennium was one of strong economic growth. As you might have guessed, the story of stocks and gold are tied to economic cycles. When we're in a period of economic boom, stocks do well, and when the economy hits a roadblock, it's gold's turn to shine.
The economy went safe again in the years of the last recession, and then stocks recovered for a few years to bring us to today. Interestingly, the economic brutality caused by the coronavirus hasn't really appeared on this chart. The data goes up to November 2020, but we can see that the relative value of gold held steady.
We think that what we're seeing here in the chart is another bottom. The only time gold was valued lower in the last 70 years was during the foolish sell-off of gold by central banks. A policy swiftly halted once they realised that they'd ballsed up big time. Incidentally, between 1999 and 2002, then UK Chancellor Gordon Brown sold 56% of the UK's gold reserves at a rock bottom price of $275 an ounce. Gold is now worth $1,800 an ounce. What a clown. A simple glance at a chart like this would have told him that this was a historically stupid idea.
We think we're at a point in the gold cycle that if we overweighted our portfolios toward gold, we'd see market-beating returns, such as by buying more of the iShares physical gold ETC. We're probably entering one of those periods of the economic cycle where everything goes to hell, starting with the lockdowns of 2020 and the economic chaos that followed.
Gold versus oil. Okay, so gold is valued at historic lows relative to stocks. What about oil? Here's gold versus oil going back 70 years. The price of a troy ounce versus a barrel of Brent crude. It flatlined in the years before 1971 because of the gold standard and oil being linked to the US dollar and therefore to gold.
Since the brakes were removed from gold in 1971, we see less of a cyclical pattern and more of a moving range between 10 times and 30 times. If gold was 30 times a barrel of oil, it would be fair to say that either gold was expensive or oil is cheap. But look at what's happening right now at the end of 2020. The ratio is over 40 times. Either gold is super expensive or oil is super cheap.
Or maybe the world is moving away from a need for oil. There is widespread belief that renewable energy will make oil redundant. However, we see this as a slow evolution over many decades still to come.
Gold is not expensive relative to stocks, as we've proved, so maybe it's oil that's driving this movement. And we know that the oil price has been massively hit by lockdowns and will likely rise once economies open up again.
Will oil return to its normal range against gold? History tells us it will, and we should all now be buying oil according to this data, and lots of it. Here's a video detailing how we'd go about buying oil, linked to in the description.
Is UK property expensive? Relative to stocks, it's a super cheap time to buy residential properties. It's mostly stocks driving this movement though.
The peaks coincide with economic downturns. The inflation of the 70s and 80s and stock market crashes of 2000 and 2009, and the dips with periods of stock market growth.
We see a similar story though when we compare UK houses to gold. The average UK property is not far away from being worth just 100 ounces of gold. The period since 1971 where property was cheaper than this didn't last long, and pre-1971 was an unnatural time for gold. Nixon really did change everything when he unhooked gold from the dollar.
But it feels like property is expensive and getting more so. But this is because cash is getting more worthless. This chart shows how house prices since around 1900 have been rising as a multiple of earnings. What we conclude from this section is that properties are cheap, but your wage is not able to keep up.
Small caps or large caps? Back to stocks, what analysis can be done to beat the market over the long term? Well, one way is look at the cyclical pattern between small caps and large caps. Small cap stocks are not really small. Investopedia defines them as companies with values between $300 million and $2 billion.
But they are much smaller than the companies that make up the S&P 500, for instance, which range from $4.5 billion to $2,000 billion, or $2 trillion. And small caps go through long cycles of over and underperformance relative to large caps.
Here's a comparison over the last 30 years, showing small caps dipping and then going up fairly consistently relative to large caps. There's a dip here which could be the start of a downtrend, but overall small caps are still relatively expensive in 2020.
Whole world data was limited for small caps, but we found this chart which looks at the top 3,000 US companies, comparing the bottom 2,000 to the 1,000 largest. The trend from the last graph is visible in this range here, but prior to this time we can see that small caps were doing much better. Some would cite this as a reason to buy small caps now.
We're taking a balanced approach with small caps. To us they look mid-cycle. Going back to the recent history, a lot has changed since 1990 in the stock market that represents a permanent shift, starting with the invention of the internet.
Although they look expensive now compared to the rest of the modern era, a small cap stock can launch on the internet and take over the world in less than 10 years.
Amazon, Facebook and Google didn't exist in 1990 and are now all among the top 10 biggest companies in the world, and small caps have shown historically that they can outperform current levels.
What we're doing. We'll hold our small caps position at 18% of equity. Still a large weighting, but without going mad. We're giving more of a focus to gold and silver in our portfolios. Silver moves in line with gold, but with more volatility. Where before they took up 5 to 7%, gold and silver are now taking up 10% of our total portfolios, and we're thinking of increasing this a little further, but it's a difficult decision to allocate so much of our portfolio space to an unproductive asset.
We said back at the start of the first lockdown that the time was right to buy oil, and we think it still is. I will be holding onto my oil stocks in the short term until there's a recovery in the oil price. The price may be slightly higher now than what it was during the 2020 crash, but compared to the long-term trends, it is still ridiculously low.
You still need to hold a majority of stock market funds or ETFs, regardless of these trends. There'll always be an exception to the rule. Owning the world will always be the best starting point, but you can overweight at the edges towards historically cheap assets.
You could take this further and compare other assets yourself, or you could run a comparison of stock market industries to see if there's any historical trends worth knowing about. Let us know what you find.
Question of the day: how will you be tweaking your portfolio as a result of these findings? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.